What if I told you that the most dangerous thing an investor can do is be certain about the future? Benjamin Graham spent pages proving that the market's past is a confusing mirror, sometimes helpful, often misleading. In this video, you'll learn how to read a century of market history like a skeptic, why the crowd's enthusiasm is a red flag, and the simple portfolio rule that can save your retirement. Stay with me. Chapters 3 and 4 are where Graham gets practical. Chapter 3 walks us through a long view of stock market history and shows why valuations matter, not as prophecy, but as risk gauges. Chapter 4 turns that history into rules for the defensive investor, the person who wants protection and steady returns rather than thrills. We'll translate Graham's historical warnings into concrete actions you can use today. Graham's point in Chapter 3. Look at a long timeline and you'll see two things. The market swings wildly, and valuations at any point matter a lot for future returns. History doesn't give you a prediction, it gives you probability and warning signs. Graham examines long-term price earnings and dividend yield data to show that when stocks are priced high relative to earnings, future returns tend to be low, and vice versa. That's not a guarantee, but it's a reliable relationship. Pay more, get less. He spends a lot of time comparing stock yields to bond yields to show when stocks are relatively attractive, and when they're not. People love to believe that the past will keep repeating. If stocks returned 10% last decade, some will tell you to expect the same next decade. Graham says that's dangerous hubris. The only thing history reliably teaches is that the future will surprise you, often in the opposite direction of what you expect. So humility is an investment skill. An important, underappreciated point Graham makes. Stock returns don't exist in a vacuum. The yield on high-grade bonds sets an alternative return for investors. If bonds yield a lot and stocks yield little, you pay extra risk to own stocks, and that risk isn't always justified. Graham uses historical comparisons to show times when bonds were better value than stocks by this yardstick. From the historical data he analyzes, Graham doesn't promise fireworks. His conservative projection for stocks over the next decade is modest, not because stocks can't rise, but because paying high prices compresses future returns. In plain terms, if you buy stocks at a high valuation, expect more modest long-term returns. That's the sober lesson. So how should you use history? Not to bet on timing, but to pick the degree of risk you accept. If valuations are stretched, be defensive. If valuations are cheap, you can be more conservative about owning stocks. Graham gives neither rigid prediction nor a crystal ball. He gives a compass. Think of it this way. If a house is twice as expensive as it should be relative to rent, you don't buy it expecting rents to magically go up forever. Similarly, when top-line market valuations are elevated, don't buy with the assumption the next decade will match the last. Expect mean reversion surprises, budget for them. Chapter 4 is a practical manual for the defensive investor, someone who wants safety, simplicity, and a minimum of ongoing trouble. Not everyone wants to be an analyst. Graham lays out rules for people who want to sleep well at night. Here's Graham's cornerstone practical rule. Your allocation to common stocks should never be less than 25% or more than 75% of your portfolio. The inverse goes to bonds. For many investors, the default should be 50-50, equal parts stocks and bonds, and then adjust within the 25-75 band depending on whether valuations seem cheap or expensive. That simple rule keeps extremist bets off the table. Graham isn't prescribing a single holy number because circumstances change. If the market becomes a bargain in a long bear market, increasing the stock percentage makes sense. If prices look dangerously high, reduce stock exposure. The point is disciplined range rather than emotional extremes. Graham also recommends formula-based strategies for defensive investors who don't want to predict the market. Dollar cost averaging, investing a steady amount over time, is one example that historically smooths timing risk. Another is the 50-50 plan. Keep an equal split and rebalance periodically. Both are simple ways to discipline behavior and avoid buying high or selling low. For the defensive investor who will hold stocks, Graham suggests sticking to high-quality, well-established companies with a record of earnings and dividends. Diversify across many issues to avoid idiosyncratic risk. Don't chase hot growth stories. Defensive investing is about protection first. Graham also notes bonds carry risk, especially when interest rates rise. Long-term high-grade bonds can lose market value in a rising rate world. That's why he stresses a balanced approach. Bonds cushion stock drops, but they aren't riskless insurance if you lock in long maturities at low yields. The defensive investor accepts lower potential returns for less hassle and lower risk. If you want higher returns, you must be willing to study, act, and sometimes tolerate discomfort. That's the enterprising investor's domain. But if your temper and time call for defense, Graham gives you a clear conservative path to follow. If you're defensive, here are succinct rules from Chapter 4. Keep 25 to 75% of assets in common stocks. 50-50 is a good default. Use high-grade bonds for the bond portion. Avoid junk unless you're enterprising. In stocks, favor large, well-financed companies that pay dividends and show earnings records. Rebalance periodically, e.g. annually, or use dollar-cost averaging to add discipline. Many investors make the mistake of adopting a defensive label but behaving like speculators. They chase performance, follow hot tips, or hold undiversified positions. Graham's guardrail is this: choose a temperament and follow its rules. If you call yourself defensive, actually act like one. 4 practical takeaways you can implement today. Respect valuations. History shows paying high prices reduces expected returns. Let price inform your allocation decisions. Use the 25 to 75 rule. Never let stocks fall below 25% or exceed 75% of your portfolio. 50-50 is a sensible default. Automate discipline. Dollar-cost averaging and scheduled rebalancing turn good intentions into good results. Match style to temperament. Defensive investors prioritize safety and simplicity. Enterprising investors accept complexity and effort for potentially higher returns. Be honest about which you are. Which of Graham's rules would you feel comfortable adopting? The conservative 25-75 guardrail or the discipline of dollar-cost averaging? Tell me in the comments. And if you're defensive, tell us your current stock-bond split. I read and reply to the best comments. If this helped, hit like and subscribe. Next video, we'll use Graham's rules to design a sample defensive portfolio you can actually implement today. And I'll show step-by-step rebalancing examples you can automate. Want that as a template? Say, make template in the comments.